Hey everyone, welcome back to the Weekend Charts. I'm your host, Charlie Bilello. As always, I'm going to take you on a tour of markets and walk through the most important charts and themes that we're seeing today. And I want to start out with talking about the tremendous two. And here I'm talking about Apple and Microsoft, the two largest companies in the S&P 500, the two largest companies in the world. And as a percentage of the S&P 500, they have never been larger in terms of just two companies. If we go back in time, we have data going back to 1980, and the current percentage of 14.7% for Apple and Microsoft together is higher than any two companies that we've seen over this period of time. And previous to the last few years, you had to go back to the early 1980s to find two companies with this high of weighting, and that was 10.9% for IBM and AT&T. And of course, both of those companies not near the top in terms of market cap today. And what we're seeing here is just an enormous outperformance for Apple and Microsoft as compared to the rest of the market this year, which is driving that increase in concentration. And if we look at the charts for Microsoft and Apple, you can see the downturn in 2022, where both of these companies underperformed the index, but this year far outpacing the index. Both Apple and Microsoft hitting new all-time highs this year. The S&P 500 is still about 5-6% below its high. So you have that outperformance driving things. Microsoft this week hit an all-time high. Apple a little bit below its high from a few months ago, but the strength here is pretty evident. You can see just an enormous run up into 2022. Last year underperformance, but this year far outperforming. And what's been the big driver of the growth for these two companies over the last decade? Number one, of course, is fundamentals, and that would be the biggest part of it. You're talking about increase in revenues, increase in net income. But number two would be multiple expansion. So it's not simply that profits are higher, it's that investors are paying a higher multiple for those profits today than they were a decade ago. And if you look at something like Apple, it's trading around 10 times or 10 to 12 times earnings a decade ago. Today, it's 30 times earnings. If you look at its price to sales ratio, it's more than doubled over this period of time. And now Apple has a price to sales ratio around 7.7. So it was less than half if we're looking at a decade ago. Microsoft, similar story. Price to sales ratio was below 5. If we're looking at 10 years ago, today over 12. PE ratio obviously expanding as well to the upside. So if we're looking at what's going to happen in, let's say, in the next 10 years, to be as optimistic as the last 10, you would have to say that multiple expansion is going to continue to go on, and you're going to continue to see the growth rates that we've seen in the last 10 years. Is that likely to happen? No. Is it impossible? Of course not. But just tremendous looking at these two companies, the growth that we've seen, and the concentration in the S&P 500 is something for, of course, investors to think about in terms of diversification. Probably more important now than ever before because of that higher concentration you have in just those two companies. So let's expand it here. Look at the Fantastic Four. So now I want to bring in Google and Amazon and talk about these four companies as a whole here. And this is something I update every earnings season, but the number just keeps getting bigger. And the stats are just incredible to think about. You're looking at combined revenue for Apple, Amazon, Google, and Microsoft of now 1.45 trillion. That's a new high in the third quarter. And that's actually higher than the GDP of all but 13 countries around the world. So these four companies are become like a country, an economy on their own. And it's just astounding growth. If we're looking at the last 10 years, 10 years ago, these four companies' total revenue was 373 billion. Today, 1.45 trillion. That's 15% per year in terms of growth. And these weren't small companies a decade ago. So for them to collectively grow at 15% per year in terms of their revenues, just unexpected, of course, and just enormous growth. And if we zero in on Amazon, and this is a chart I like to update every year, Amazon versus Walmart being the number one revenue company in the S&P 500, Amazon number two now. And it's not going to be too much longer, it seems, before Amazon passes Walmart. But just look at the change in the last 25 years. Amazon went from essentially nothing. If you're looking at 25 years ago, Walmart had revenues 305 times larger than Amazon. 10 years ago, Walmart still had revenues that were 7 times larger than Amazon. Even 5 years ago, Walmart's revenue was still double that of Amazon, but today just 1.1 times higher. And if these, obviously, the growth rate for Amazon continues to exceed Walmart, it's going to surpass it in the next few years. So if we look at Amazon, we know everyone is familiar with Amazon Prime and the growth there, and almost a vast majority of Americans obviously have a subscription there, and that's been a huge growth driver. But the other story that may be less well known is Amazon Web Services, AWS, their cloud business, and that's just seen unbelievable, ridiculous growth over the last 10 years. We're looking at going from 3 billion in revenue per year to 88 billion today. That's 40% annualized growth per year, and just an incredible statistic by itself. But if you look at that total $88 billion revenue number, that's actually higher than the revenue of 461 companies out of the 500 companies in the S&P 500. So by itself, this AWS is just an enormous business, and obviously a big driver of Amazon's growth and their operating profits in recent years. Just a huge driver for Amazon. And let's now expand it to the enormous eight. This is something that I've coined it, bringing in now Tesla, Nvidia, Netflix, and Meta to that group of four, to the Fantastic Four. And I want to break down here 2022, 2023, and then the combined returns of both of those years. And what you can see here, obviously jumping out first, 2023, huge gains across the board. And this has not been the experience of the average stock, as we'll talk about in a little bit. Just unbelievable gains, the lowest of any of these enormous eight in terms of their total returns this year is actually Apple, which is a 44%. That's the lowest of these eight companies. So just a tremendous year across the board. And if we combined 2022 and today, and you can see 2022, all of these stocks were down, and all of them were actually down in excess of the S&P 500. This year, of course, all of them trouncing the S&P 500 by a wide margin. If we combine the two, we can see that Nvidia has the highest combined return, so obviously hitting all-time highs and just continuing to run up higher since that point. Microsoft also hitting new highs this year, and Apple as well. But the remaining members of the enormous eight still have a little bit a ways to go to get back to that prior high. If we look at Meta, it is currently 3% below if we're looking at the 2022 losses, and Tesla is 39% if we combine the 2 years. So not all of them have been equal in terms of coming back, but the commonality here is that they all underperformed in 2022, and they're all outperforming by a wide margin so far this year. And so far, that has led to a resurgence in this large cap outperformance of small caps. And if we look at that ratio between small caps and large caps, it's now at its lowest level since 2000. And you can see this move lower this year, another leg down for small caps. We talked about various reasons, but part of it is just the tremendous strength in the enormous eight and large caps and the fundamental drivers there. The other part is the perception that higher interest rates are going to be harder for smaller companies. And some of that is, of course, real as well. And the question for investors is this going to be similar to the standpoint of 2000, where that's then set off a period where small caps outperformed, or do we have more to go to the downside? And of course, no one knows the answer, but what we can say is certainly we're at an extreme in the direction of small caps underperformance. And if we look at relative valuations, let's say of small caps versus large caps, we're at an extreme as well. So this has been a consistent theme outside of this huge run up that we saw in 2020, where small caps have been underperforming. But now we're looking at the lowest levels in terms of relative strength since December 2000. And if we just look at the last 10 years and look at some of these numbers for the enormous eight, and here I included AMD in that as well because of just how important semiconductor strength has been in terms of the story for the U.S. and certainly this year. But we have the last 10 years, the returns on some of these things is just astounding. Nvidia is actually now higher than Bitcoin over the last 10 years, which I think would surprise a lot of people because Bitcoin's up 11,000% over the last decade. Nvidia is actually up 13,800%, but even AMD is up over 3,000%, Tesla 2,200%, Microsoft and Apple, the two biggest companies in the world, up both over 1,000% each. And you could see the S&P 500, not a bad return whatsoever, up close to 200% in the last decade, but seems small by comparison. And overall inflation was 32%. So this has been a decade of story stock outperformance. And that's not to say that other decades haven't been, but I think more so this past decade is really being led by the names that and the products that you use in terms of Apple and Microsoft and Google and Amazon. And Netflix. These are products that a lot of American use on a daily basis. So I think that's kind of driven a lot of the story here in terms of accelerating the returns to the upside because people feel comfortable with the stocks that they know, and that's been definitely part of the multiple expansion. And so the expectation today from investors is pretty high. If we look at all of these companies, none of them are trading at a discount to, let's say, their average multiples of the last 10 years. All of them are trading at a premium. And the big question for investors looking up forward for the next 10 years, the next 20 years, is how many of these leaders are going to continue to lead, and what will the new leaders be that aren't on this list. So let's talk about that inverse. So we talked about the inverse between 2022 and 2023 in terms of the enormous eight, but let's look at it into perspective of broader market trends. And really, it's been a story of large cap and growth just absolutely coming back in a rapid fashion. It's just really been a V-shaped recovery in terms of growth versus value, in terms of large cap versus equal weight. Pretty much the exact opposite of what we saw in 2022. So 2022, we had value stocks outperform, we had equal weight outperform, we had the mega caps and growth and NASDAQ 100 underperform, and you could see all of that in the red here. But this year, polar opposite, NASDAQ 100 leading everything, and we know the reasons why. We talked about Apple, Microsoft, and the rest of the big tech names all in the NASDAQ 100. But growth trouncing value. This year, value is roughly flat, growth up 32%. So huge spreads between these factors. And they were huge last year as well. So we're just seeing really a manic investor behavior where they're switching from hating growth last year to loving it again. And anyone's guess what happens in 2024, but it's just been remarkable to see this. And then especially energy, right? Everyone loving energy. Was the only sector that had a strong return in 2022. Was up 64%. It's actually down so far this year, down 2% if we're looking at the XLE sector. And if we broaden it out to include the other sectors in the S&P 500, you can see that all of the gains this year for the S&P are being driven primarily in these three sectors: tech, communications, consumer discretionary. And what you'll notice here in the red is these were among the worst performing sectors in 2022. So complete reversal. 2022 was more of a safety trade. In addition to obviously energy, you had crude oil advance driving that to a large part, but with the exception of energy, you had things like consumer staples and utilities outperforming last year. So more defensive sectors. This year, the opposite. You're looking at things like tech and more cyclical areas of the economy. And a big driver of that, of course, has been the fact that the predictions of a recession, which a lot of people were confident of in 2022, well, they haven't materialized so far in 2023. And so investor money has come right back into the old leaders, which is really tech and growth and large caps. So let's switch gears here. Talk about rising delinquencies in credit cards and other loans that are slowly moving up. Certainly, it's hard to say that they're at an extreme where it's going to cause problems for the overall economy just yet, but definitely notable. And if we're looking at that credit card debt, we got new data for the third quarter, and U.S. credit card balances hit a record high again. 1.08 trillion. And what we saw over the last year was an increase of 16.6%. So we're still seeing credit card balances increase more than the rate of inflation. So people are taking on more credit card debt. And for the people that are doing that, why it's so problematic is that credit card interest rates are at their highest levels on record, over 21%. So not a good combination. You have more credit card debt and a higher interest rate, becomes harder to service that debt. And so, perhaps no surprise, we're seeing a higher share of credit card balances transition into delinquency, up to 8%. Now, again, not extreme. If you go back to the financial crisis, we saw a much higher percent, but in terms of the trend and where it's going, not in a direction that you want to see. If we look at auto loans, we're seeing something similar in the subprime area. So borrowers with lower credit ratings, we're seeing the highest levels of subprime delinquencies really on record, above 6% now in terms of the percentage of subprime auto borrowers in delinquency. So what's driving that? We've talked about this huge spike in interest rates, harder to service that debt. A lot of people are stretching, buying cars they couldn't afford. Of course, car prices exploded to the upside after following COVID 2020, and the inflation advance drove up car prices to unaffordable levels. And now you have most people financing the cost of that new car, over 80% of people financing that. And at these rates, at above 8% rates, and that's average rate, right? If you have bad credit, you could be paying definitely well in excess of 10%. It just becomes harder to pay that off. And what a big change, especially if you have a variable interest rate on this debt. All of a sudden, you went from paying 4% to 8%. So not a huge surprise to see lower credit borrowers starting to default on that. So we'll see if that starts to have an impact in terms of prices of cars. And I've been following this Manheim used car index pretty closely. It's the closest read that we get in terms of a leading read, because it's looking at wholesale used car prices, which tend to lead retail prices. And now what we're seeing is the lowest level for this index since March 2021. Certainly not giving back the huge increases that we saw in 2020 and 2021, but giving back a portion of it. And this is a leading indicator for retail prices. And what we should see over the next few months, and I'll give an update next week, is lower retail prices for the car market. So that's good news. If you've been waiting to buy a used car, you're likely to see lower prices over the next few months if this index is an indicator, which it has a pretty good track record of being that. So I would expect to see lower prices. We've talked about Tesla prices are down over 40% in terms of used car prices, and that trend has continued this month. And so I'll update that again next week. So we're slowly normalizing here. It's causing definitely some, coming at the heels of some pain if you reached and you bought a car that you can't afford. But I think overall, if you are waiting for car prices to come down, this is the first real strong indication that we're seeing here that over the next few months, retail prices should be lower. So let's talk about overall inflation. CPI should show a decline. You're going to get this CPI report next week, and so I'll have an update on that. But I'm expecting it to decline by a decent amount. I think the Cleveland Fed number should probably be close. Maybe even come below this, but Cleveland Fed is projecting a move down to 3.3% for October, and then another move down in November. But that's a good sign. So we jumped up to 3.7%. So if we start moving back down and we get below that 3% level, I think that's great news. Part of the driver for that is the unexpected fall in gas prices. So if we're looking at the national average, we're now down to $3.40 a gallon in the US, which is the lowest we've seen since March. And importantly, here for CPI is comparing to where it was a year ago. So looking at 2022 prices here, you can see that gap, and that's going to be a tailwind for CPI, helping to push it lower. Talked about used car prices as well. That's going to be a continued tailwind. And the big number, of course, for CPI is going to be that housing number. As we discussed last week, rents continue to trend lower. So we'll see if this will be the month finally where CPI really starts to catch up with the real time housing data, which is showing definitely a fast deceleration or even decline in terms of asking rents. So what will the Fed do when it meets next month? This will be the last meeting of the year. Market expecting no change. So definitely a big difference from a few months ago where the market was saying we're going to get another hike out of the Fed. Market now saying Fed stays put at 525 to 550. And market's essentially saying, as I discussed last week, that the Fed is done for this cycle, that they won't need to hike rates again. But if you listen to Powell, he spoke again this week. He's still hedging that bet. He's still talking the talk. He doesn't want people to think that interest rate cuts are coming anytime soon. I think he wants to be more confident that that CPI is going to come back below 3%. We're going to see core inflation back below 3% before they start even thinking or talking about cuts. That's assuming we don't see recessionary data really start to take hold. If that is the case, then I think all bets are off. But assuming we don't see that, I think the Fed wants to stay restrictive for at least a few more months. So looking at talking about a rate cut, let's say in January or February, does not seem to be on the table. It's Fed is going to be on hold for now. And if we look at central banks globally in terms of the picture today versus 2 years ago, just an absolutely remarkably different situation. If we go back to October 2021, myself, many other people were kind of screaming, this is crazy. The Fed, what they're doing, what the ECB is doing, these other central banks are doing in terms of negative real interest rates while inflation was really starting to surge higher. The Fed at the time was still at zero. The ECB was at negative rates. You had Denmark at negative rates, Switzerland negative rates, and many of these countries had negative real rates. So if you adjusted for CPI, you took their central bank rate, subtracted CPI, you had negative real interest rates, which was extreme because you had all of these places were seeing higher inflation rates, but very few of them were doing anything about it, particularly in the developed world. You were seeing emerging markets starting to hike interest rates, but not in the developed world. So today, where are we? Very different story. You can see more countries now have positive real rates, so they have a central bank above the rate of inflation, and many of these countries we've seen the inflation rate come down off of the peak in 2022 or earlier this year. And so monetary policy went from being ultra easy to today restrictive. And the question, I guess, for 2024 is, are we going to start to see more of these countries flip from hike to cut? So far, as I've talked about, it's been mostly Latin America. We've seen Peru, we've seen Chile, we've seen Brazil, likely to see Mexico start cutting rates at some point. They have a big gap here between their central bank rate and their inflation rate. But the question is, when are we going to start to see developed world start to cut interest rates? If the markets are correct for the US, the market's saying next June, we're going to start to see a rate cutting cycle. So perhaps 2024 will really start to look different in terms of flipping back to perhaps an easing policy. But for now, a lot of these countries are on hold and just waiting to see if there's a resurgence in inflation or if the economic data turns south. But what a difference over the last 2 years from negative real rates to positive real rates, and from not caring about inflation to really attacking inflation. And if we look at where we are today in terms of the absolute levels of these interest rates, you're back to a much more normal scenario as compared to where we were for many years after the global financial crisis, which was kind of a crazy situation. If we looked at Europe and Japan's actually still there in terms of negative interest rates, but Europe, as for now, has gone back to normal in terms of having a positive interest rate And the US, as we talked about, yes, above 5% seems extreme, but that's only because of how ultra easy the Fed was previous. So this is not anything historically. This central bank rate compared to the inflation rate, the 1.7% spread would actually been viewed as quite normal. So this isn't extremely tight monetary policy by any means. It's just really a return to normal, and we'll see if the Fed continues to fight the fight in the next few months and to continues to maintain that restrictive policy and wait until they get that 2% reading in terms of inflation. So let's talk about spending here. Spending on experiences has been the key for the US economy. We talked about that third quarter real GDP number getting a huge boost from the US consumer. And a big part of that was spending on experiences. We look at travel, we look at concerts, we look at hotel spending, all of that showing a big bump in the third quarter. Over the summer, a big resurgence in terms of the American consumer traveling, and concert tickets have been uh, higher priced this year than we've seen in a long, long time. Obviously, we haven't seen anything like the demand for this Taylor Swift tour. At least I haven't seen it. And this is just an indication that it's not quite over just yet. Or it doesn't seem to be. I looked online for tickets for next October, so October 2024. The lowest priced tickets for this Taylor Swift concert were over $1,500, and these are tickets for resale. So certainly seems to be a lot of demand still for these high priced concerts. And if we look at the travel sector, we just recently broke a streak a few days ago of 68 straight days where we were higher than 2019 levels. So you could see that gap here. I'm comparing in this chart here the number of airline travelers in the US to 2019 levels. And we were consistently above it for 68 straight days, which is the longest stretch since 2020. So American consumer still appears to be spending, especially on experiences. And if they continue to do so, that's going to continue to help the economy. The question is, when do they start to pull back, and do those higher interest rates in terms of credit cards start to have a bigger impact on that, and the higher interest rates, I guess, in general. But for now, that doesn't seem to be the case. So quickly, I want to talk about housing. And we've been talking about the story of lower housing supply keeping prices elevated, and that supply has really crashed more than demand has crashed. And that's why prices, if we look at the US as a whole, are at record highs. But we're starting to see some signs here. This is very early, but some signs of a normalization. This is data from Redfin. If we're looking at the active listings of homes for sale, still down on a year over year basis. But if you look at this orange line here, this is the trend for this year. What you'll notice is, unlike the previous few years, if we look at 2020, 2021, 2022, at this point, you were seeing a decline in listings, and you tend to see that there's seasonality to the housing market where you tend to see an increase in listings and an increase in prices going into the spring and the summer, and then it peaks out and falls in the fall and the winter. But this year, at least so far, we're not seeing that. We're seeing listings remain high, actually still increasing here in November. So perhaps that's an indication that the tide is turning in terms of supply. And another indication in terms of perhaps we're seeing a little bit of softening here in terms of the housing market would be that 6.8% of listings had price drops over the last 4 years, 4 weeks, and that's the highest we've seen with data going back to 2020 here. So why would people be cutting prices? Well, they're having a harder time selling that house. And the primary reason for that is going to be affordability. If we look at the average mortgage payment needed to afford the median priced sale for home, median priced home for sale in the U.S., it's still hovering near a record high of around 2,700. And again, this is just that mortgage payment. If you add in the cost of insurance and cost of taxes, cost of everything else, that's going to drive this up much higher. So certainly this is a big factor. If mortgage rates come down, perhaps this is obviously going to change the math of it. But the big story in the housing market for this year has just been the absolute standstill in terms of activity, because we have a collapse in demand from the buyers that simply can't afford the average priced home for sale. So more inventory would certainly help bring prices down. Obviously, with mortgage rates came down from these elevated levels, that would help as well. And the big story of 2024 is going to be whether we're going to finally see prices come down in a meaningful way. We haven't seen that. We saw a little bit of price weakness in 2022, but prices came all the way back and more in many areas for 2023. So next I want to talk about a company that went from 47 billion to essentially zero in just a few years. That company, of course, being WeWork, which filed for bankruptcy this week, Chapter 11. And I don't think that surprised or shocked anyone. I think a lot of people thought it was coming. But what was surprising to me actually was back in October 2021 that this company was actually able to go public through a SPAC, and not only go public, but actually command a market cap at the time of 8.2 billion. That was just, to me, incredible given the history of mismanagement, of losses, that the mania was so big back in 2021. The euphoria was so high that even a company like WeWork was able to go public and do so at an 8.2 billion valuation. But eventually, as we talk about many times, is the weighing machine sets in, and that's the idea that fundamentals do matter. If a company's consistently losing money, eventually that's going to be a problem. And for WeWork, the math caught up to them this week. And so if we look at that WeWork net income, consistent in one direction, in that it was negative, and total losses since January 2016 for this company, 16 billion. So just incredible. And as I said here, history of losing money heading into that IPO in 2021. So it shouldn't have been a surprise that losses continued. And what a transition in terms of the market sentiment from back in 2021 to today, where all they cared about back then was growth. If when WeWork, the story for many years for WeWork was how many new locations, how many new members. Nobody cared about profitability. The environment today, very different. So WeWork probably won't be the last company that we're talking about in this regard, where they haven't been able to get to profitability, and now investors are caring about that. So I want to end, as I always do, with something positive. That's the fact that I bonds, and I've talked about these before, are becoming more attractive in terms of outpacing inflation. That's because they're fixed rate. So I bonds have two components. One is a fixed rate that you get for the life of the bond, and you add to that every 6 months the inflation rate. So whatever the CPI is for that period of time, they add it to that fixed rate. And today, a fixed rate of 1.3% is the highest we've seen for I bonds in some time. Just a few years ago, it was actually 0% fixed rate, and all you were getting was the inflation rate. So good news for I bond investors. You're now going to get 1.3% above whatever that CPI is for as long as you hold these bonds. You can hold them as long as 30 years. After 5 years, if you hold them at least 5 years, you get no penalty after cashing them in. So what we've seen here is just increasing attractiveness of these inflation adjusted I bonds, where you're now looking at getting 1.3% above inflation, whereas in May 2022, you're looking at 0%. And so regardless of what inflation does over the next few years, if it's high, if it's low, you're guaranteed in this vehicle to get 1.3% above that reported CPI inflation. And could that number go higher? It certainly could. So we'll get the next number next May. And I just went back and looked at the history of these I bonds back in the late 1990s and early 2000s. You actually had a fixed rate above 3%. So that would be obviously enormously attractive for investors if you guaranteed to get 3% above inflation. That's a pretty good. So hopefully, perhaps that'll happen for investors again. But today, at least, you're getting that 1.3% above it. Now, the question for longer term investors is, are I bonds going to be the best inflation hedge? Probably not. If you look at the last 100 years, it's been the stock market by far. S&P has averaged around 10% per year. You got inflation around 3%. So you're looking at 7% inflation adjusted return for stocks. What's the catch? Well, stocks, unlike I bonds, can go down. They can go down significantly in short periods of time. So the price that you're paying for that higher real inflation adjusted return is the prospect of bigger drawdowns. And so for people, at least for the part of your portfolio where you don't want to take any volatility risk, I bonds are an interesting vehicle where you're at least what you're going to get in terms of you're going to get that whatever that CPI is, and now you're going to get 1.3% above it. So let's end it right there. We covered a lot of ground this week. Thanks everyone for joining. As always, if you like the content, subscribe to the channel for more content just like it. Have a great weekend. Happy Veterans Day. Thank you, all the vets out there, for your service. And I'll see you next time on the Week in Charts.